Just learning to invest? If so, there are some very common investing mistakes that can end up costing you a lot of time, money, and potential heartache. I'm going to break down 8 of those mistakes right now and how to avoid them. Hey everyone, this is Lauren Mack with Hacking the Rat Race, and I would love for you to hit the like button and subscribe so you don't miss any more videos on money, saving, and investing. I'm about to jump into the first one, but you will want to stay until the end because the last one is super common and can literally result in negative returns over time. Not only would you not make money, but instead you end up with a massive loss. I want to hear from you in the comments below. What is your biggest investing mistake so far? I'll leave mine in the comments below so you can see it there. Quick disclaimer. I would like to add that I am not a financial advisor and you should always consult your own financial advisor before making any investments. We're going to get started right now with the first mistake beginners often make, and this can end up costing them so much money. That is letting emotions determine when you buy, sell, or hold a stock. If you ask most people, what is your risk tolerance, high or low? Generally speaking, people will say low, especially when the market's going up. But once it starts to go down, even a little bit, people start freaking out and selling. Oftentimes, these people are too scared to invest until the market gets really high and the fear of missing out kicks in because people are making so much money. That is when they decide to invest. Then, when the market goes down, they freak out and sell because they're afraid they'll lose all of their money. It is hard because there is so much that we wrap up into money, and of course nobody enjoys losing money, but you have to fight the urge to buy high and sell low just because of the emotional roller coaster. That is why learning to invest objectively by looking at the numbers is so important. The best way to avoid this mistake is to understand the basics. Look at buying a stock or a fund like you would buying a big ticket item. Do your research and make sure it makes sense. This is basically the same as saving up $50,000 to buy a baller car, not doing the research, and just buying the first vehicle someone suggested. You would never do that. You would be looking up gas mileage, how long will it last, safety ratings, what kind of bells and whistles are included. You might be thinking, I'm not investing $50,000. I'm only investing $150 a month. And while that may not seem like a lot, with a 10% return over only 15 years, that equals just over $60,000. That is even more than you saved for the $50,000 car. Remember, when the market's up, you should be happy because you're making money. When the market goes down, you should be even happier because investing during this time will make your wealth grow exponentially faster. The next mistake is that beginners often buy into investments they don't understand. Warren Buffett, one of the greatest investors of all time, says, "Never invest in a business you cannot understand." So many times there are hot stocks or the newest thing or a company, but if asked to explain the business model, what they do, how it works, oftentimes people are at a loss. And this is especially true when people are following hot tips. The problem with this mistake is that if you don't understand, then you will not know when things are happening that can impact the future outlook or the stock price. Conversely, if you do understand what you're investing in, then you'll be able to stay on top of what is happening in the market and understand if any changes will ultimately affect the price of the stock long term. The next mistake is having unrealistic expectations on returns and timelines. Investing in the stock market is not a get rich quick. And anytime someone's offering you a scheme to get rich quick, you should be wary. You can't guarantee the future based on historical performance, which is actually another mistake beginners often make. How's that for a bonus mistake? But it can give you an idea of what you could expect coupled with research on the company's current standings, the future outlook. The problem is people oftentimes think they can beat the market and say, get a 20% return on investment, and when they don't, they give up. Another area where I see this is people expect massive growth right out of the gate. Investing is long-term, and as you can see on this chart, the magic of compound interest really starts taking off later. Look at the difference it makes over 30 years as opposed to a regular savings. It's best to determine a realistic return, project out the returns in the future, focus on what it will be like when you hit that number and how you can get there as fast as you can instead of focusing on the smaller deposits today. Investing is the long game and your future self will thank you for it. The next mistake beginners make is focusing on the stock market price versus the value. This was one of my first mistakes, which thankfully was corrected early on, and I see people doing this all the time. They are, for example, new to investing and comparing a few different funds. Some funds or stocks are way cheaper than others, so they think having more shares of the cheaper fund is the best deal, and that isn't always the case. You often see this with penny stocks. People think they're getting a ton of stocks for not much money and that they can strike it rich quickly. Yes, some people have luck with penny stocks, but that is not long-term investing strategy. It is more like gambling because penny stocks are often very volatile. It can make more sense to invest in a more expensive stock that is stable and has growth potential over time versus a cheap volatile stock that can gain or lose its value very quickly. The next mistake is not adequately diversifying. I see this happen all the time. For example, where people have just been pouring money into the Tesla stock. And yes, it has exploded and many people have made massive amounts of wealth. But then they're not diversifying their earnings or rebalancing their portfolio. Tesla skyrocketed up, people got rich. But it could just as quickly drop like a rock, and literally all those earnings and wealth are just wiped away overnight. Diversifying your portfolio is so important. A good way to do that is to look at index funds. There are literally index funds for almost any market segment, and then instead of buying a bunch of individual stocks, you can buy a piece of the huge pie. If you aren't interested in index funds, then it's important that your portfolio is well diversified. So if something happens to one stock or sector, it does not completely wipe out all of your earnings. Another mistake I often see is people buying more and more of a falling stock without looking at why it's going down. Again, this often goes back to someone only looking at a few factors like price or the PE ratio or even the dividend yield without looking at the why. This was one mistake that I made in the beginning as well, which was understanding what was actually happening with a company and how this was going to impact the stock price over the long term. Looking for stocks that are temporarily beat up due to some bad news can be a great way to get a good deal or lock in a great dividend yield. However, this is why it's so important to be able to understand an industry or what a company does so you have a better understanding if this is a short-term problem or something that they may never recover from. The next beginner mistake, and honestly, non-beginners are guilty of this one too, and that is trying to time the market. Timing the market means you try to buy at the bottom and sell at the top. The problem is we don't have a crystal ball and we'll never know when it's at the bottom or at the top. Sometimes you get lucky, but trying to time the market can result in missing out in a lot of returns. That can mean missing out on a great deal, even though it's possible that there could have been an even better deal, or waiting to sell and missing out on selling at a good price just because it could have been higher. This is so hard for people, and even sometimes it's hard for me because I always want the best deal. However, that's not a good way to look at investing. It's best to come up with an investment plan and stick to it regardless if the market's at its lowest point or its highest point. This beginner's mistake is the one I promised you at the beginning, which can lead to negative returns and losing so much money. And that is not understanding that you have to actually invest the funds in your investment account. So many beginners think they just have to put the money in their investment account and it will be invested for them. This is not the case. You have to put the money in the investment account and then choose the funds. Many brokerage accounts don't accrue interest, and if they do, it's nominal. With the rate of inflation, money that is left in an investment account and not actually invested is just losing money year over year. Imagine the shock you would have if it came time to retire and you realized the money was never actually invested and did not grow. Looking at this example of a one-time investment of $10,000 over 30 years with 2.5% inflation, if that money was not invested and was even given a 1% rate of return, which nowadays truthfully isn't bad, compared to a 9% return on investment, the difference is $59,745.66. Not only that, but you would have lost $3,602 over 30 years by not actually investing the funds due to inflation. If you're intimidated to start investing because you don't know how to actually purchase a share or invest, you can always ask the brokerage firm for help. They are there to help you, and it's very easy to learn and understand. Don't forget to comment below, what was your biggest investing mistake? And you can check the comments to learn mine. If you want to learn more about index funds, mutual funds, ETFs, which one is the best for becoming a millionaire, then click here. Thank you so much for watching. Don't forget to subscribe, and I'll see you in the next video.